to Sectors Up Close. I'm Elena Casas. My guest today is John Stoltzfus, Chief Investment Strategist and Managing Director at Oppenheimer Asset Management. And today we're talking energy. Strong earnings are helping the sector extend this year's spectacular run. The S&P 500 energy sector is up 63% since the start of the year, and it's the top sector gainer on the index. The gain is mostly driven by higher fuel prices because of Russia's invasion of Ukraine, and it's a marked contrast to the near 17% decline for the index as a whole. Disappointing earnings from the tech-focused megacaps have battered those shares. So, with a return like that, you might think energy stocks have peaked. But there could still be some upside. If, as is widely expected, OPEC and its allies cut production again, we could see another sharp rise in the price of crude and hence a boost to the sector as a whole. On the other hand, the severe COVID restrictions in China, not to mention the demonstrations against them, are harming growth and hence demands. That's bad for the global economy as a whole and quite probably bad for energy valuations too. Well, John Stoltzfus joins me now. John, hi, thanks for joining us. We have had a volatile year in energy. We've gone from $120 a barrel to about 85 more recently. And energy prices, of course, rose and energy stocks followed them. But what's your outlook for the coming year?
What it's showing is a discrepancy in terms of, or a disconnect in a way, we think, for the price of the shares of stock versus the price of oil. Indeed, what we have is the likelihood that OPEC is going to reduce production. But the offset to that is China with the zero COVID policy, the protests that are going on there, everything slowing its economy for now. That could possibly offset that move by OPEC. And then move prices at least off of where they jumped again today, and it might bring them back down to where we saw earlier this week and last week.
Are you saying then that the discrepancy between the rise in energy stocks and the fluctuation in the crude price should be making investors wary?
Yes, indeed, exactly. You put it very succinctly.
But then, so if we talk about OPEC then heading forward, they are under a lot of pressure from the US government to pump more oil. And there are a lot of geopolitical variables here, aren't there? We've got the G7 trying to impose a price cap on Russian oil that is meant to come in next Monday. Where do you think the international market is going? Could that cap, for example, really encourage Russia to restrict supply?
Intermediate term, you've got to figure oil prices are likely to stay relatively high, because once anything is resolved in China related to zero COVID and the protests, if we get back to production coming out of China and we begin to see Europe and the UK move through this recessionary period into a recovery, demand should increase substantially, and that would likely support prices that are higher where they are today, or at least as high, and maybe if from a low to high band, probably 70 to 85 to $90 kind of band for the foreseeable future.
You're not concerned then about lower demand if we are going to go through a recession in the next few months and of course, lowering demand also from China?
I think that the fact that the U.S. is likely to either skirt a recession or have a very shallow recession will likely have demand remain fairly strong. And then as the U.S. moves towards a sustainable economic recovery, likely then our demand for foreign goods will increase, which will give a boost to demand to energy prices on a global basis as both Europe, the UK, and then the emerging markets begin to produce more goods, including China and non-communist Asia.
To your mind then, John, which energy stocks are the safest bets at the moment?
Broad diversification in terms of the oil sector. So I'd want to own something like XLE, which is the ETF for the S&P 500 sector. But I would also take a look at and see what is available in master limited partnerships related to energy that are infrastructure related to allow for the delivery of oil in other areas. So broad exposure, because we continue to think that this fossil fuel, it's not out of the way yet. and the transition period is at least a decade away, even though every year the likelihood for alternative to be more important has to be recognized.
One last question, John, on alternatives, as you mentioned then. Do you not think that in the context of the Inflation Reduction Act and with the amount of subsidy that is being provided for the switch to alternative energy, that we're reaching a tipping point in the US where that switch is becoming profitable?
I think that it's becoming profitable, but I think it's a question of scale, Elena, and that scale would lead us to believe that traditional energy. The other thing is, traditional energy has the infrastructure to deliver fuel to automobiles. We can't help but think that governments really should consider tying in existing producers of gasoline or petrol stations and have delivery of chargeable machinery to charge the automobiles that are electric that are coming online. Very much dedicated production by all the automakers around the world.
Well, thanks so much for that insight, John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. Well, that's your roundup of the energy sector. I'm Elena Casas, and this is Reuters.